Good morning, everyone, and thank you for joining us today. Hope everyone's enjoying the weather. My name is Lauren Tatum. I head up the sales team here at Foresight, and I'm really pleased today to be joined by Rachel Vahey, who is Head of Public Policy at AJ Bell. The first thing to say before we kick off, we have had record numbers for sign-ups for this webinar today. I think we're close to 460 people signed up, which just goes to show how topical still the pension changes are, them last two budgets, and really making sure as advisors we're preparing ourselves for them changes kicking off in April next year. As of always with these webinars, I just want to do a quick disclaimer. So I am not a financial advisor, so anything that you hear today is not to be taken as financial or tax advice, but really to give you intel, information to help you prepare for these client conversations. We've got an hour in the diary today, so we're going to spend 45 minutes where we're going to hear from Rachel, and we will save 15 minutes at the end for questions. Hopefully most of you are aware of how to use Zoom now, but you've got a question box at the bottom, but we have already got some really brilliant preemptive questions that have been sent through that I've shared with Rachel, but anything that does spring to mind through this session, please drop them in. With that, I will bring up quickly the learning objectives and then I will hand over to Rachel. So the outcomes for today: explain the key changes to the inheritance tax treatment of pensions from April 27 and identify which pension benefits are within scope. Assess the potential IHT and income tax implications for clients and beneficiaries under the new rules. Understand the practical process for admin, the pensions, death benefits and paying in any IHT due, including the roles of personal representatives and pension scheme admins, and then evaluating planning opportunities that may help clients mitigate IHT exposure. With that, I will very gladly hand over to Rachel and we will kick off and save questions at the end. Thank you so much, Rachel.
Thanks, Lauren. Good morning, everyone. My name is Rachel Vahey. I am Head of Public Policy at AJ Bell. Pensions and IHT. Well, this is a big subject and it's a very significant one. It's one of the major changes to pensions in recent years, and it is going to have wide implications for your clients and for their families. It's coming in about 10 months' time now. 9-10 months, so it's going really quite quickly, and we're going quickly through all the detail. It's definitely worth knowing about this one because it is going to have a massive effect on some of your clients. It's also a complicated subject, and it can get quite detailed. You are going to be able to demonstrate and prove your value and your worth to your clients, to their families, to the next generation by knowing how all of this works and what the implications are. Solicitors don't understand pensions. That's probably what I would start by saying. They don't understand pensions, certainly in the way that you understand pensions. So it's a very good way of also demonstrating your value and building really robust professional connections as well. So lots to go through this morning. I've split it up into 4 different areas. We're going to look at the essential information, look at a bit of the practicalities of this, have a look at a quick case study to see how it works in practice, and then just touch on the planning and look at the impact for your clients. Okay, so let's get going and have a look at the essential information. So as I said, we have now got about 9 or 10 months to go. So what is the change? Well, in a nutshell, unused pensions are going to form part of the estate for anyone who dies on or after the 6th of April 2027. So we're not talking about the day that you distribute the benefits, which is what's written into legislation now, a lot of changes around that. We're talking about the date of death. So it's probably important just to note that. This is legislation. This is definitely going to happen. We've got about 9 months to go. It was put into the Finance Act of 2026 a few months ago, but the main legislation has now been passed. We're getting more and more information from HMRC, and we're expecting quite a lot of information to come out this year. We've got a technical note, and I would recommend going and having a look at that technical note. It's really good. It gives a really good summary of what the current position is. But there are still a lot of blanks, especially around the process of how it's actually going to work in practice. We need information sharing regulations, and we still need guidance. There is going to be two lots of guidance. There is going to be guidance for personal representatives, for executives, so a layman's guide to it to tell them in simple terms what they've got to do. But there's also going to be technical guidance as well. And I think that is going to be very, very useful for us, hopefully include a lot of examples, and it will help massively. When we're looking at all of this, the guidance doesn't come out until absolute last gasp. In fact, the way that HMRC has written their timetable, it looks like we're going to get the guidance possibly weeks, maybe even days before the 6th of April. Now, that puts us in difficult positions, but I think it's obviously guidance is going to be well worth waiting for. So we know it's unused pensions. Let's start by taking right down to basics and saying what actually are we talking about here? And now I've split it up into different types of pension scheme. So for defined contribution pensions, for master trusts and for SIPs, the pension pots which are not yet accessed will fall into inheritance tax and any unused drawdown. So the client's taken the tax-free cash, put the rest into drawdown, not used it, not fully withdrawn it yet, that will be counted as part of the estate when working out inheritance tax. There is a feeling that goes around that people say, well, yeah, buy an annuity, because annuities are completely free of IHT, aren't they? And the answer to that is, well, they could be and they could not be. Joint life annuities are excluded. So if I die and 50% of my pension then gets passed on to my partner, then that would be excluded. That wouldn't count as part of IHT. But if I buy a guaranteed period on that annuity, and that could be anything from say 5 to 30 years, or if I choose value protection as well, then both of those, the values of both of those will fall into the estate for inheritance tax purposes. So that's well worth being aware of and watching out for. HMRC has some calculators which convert work out what the value of a guaranteed period is. But certainly lots of people buy guaranteed periods and value protection on their annuity because people just get this feeling that if they die too early, then all of their money just disappears with an annuity. I really object to that phrase, die too early, because anytime I die is going to be too early for me. But yeah, let's just go with that one. But value protection guaranteed periods are included. When you're looking at buying an annuity or not, I think lots of people may be driven to buy an annuity because of because they think, oh well, the joint life annuity is excluded from inheritance tax. But I think it's really taking it back to basics and thinking about what the client needs. If the client doesn't want more flexibility and wants to pass some money down to their family, even if it's counted for inheritance tax, 60% of something is better than 100% of nothing. So if that's the situation and they want more flexibility, be able to vary their withdrawals, then drawdown is still a really good option. So before people rush out and buy an annuity, just go back to basics and think, why did they want drawdown in the first place? And then defined benefit schemes. Now, we often think defined benefit schemes aren't touched by this, and it's certainly true that most of defined benefit schemes aren't touched by it. Scheme pensions are excluded. Death in service lump sums paid out are excluded as well. So let's be very cynical here and say, well, the government and the civil service, they're not really affected by this really significant change in pensions. It's those people who have money purchase pensions, who have SIPs, who are going to be affected. But watch out for AVCs. Money purchase AVCs are included. So you might have added years or added pension AVCs, and they're not. But the money purchase AVCs, even if they're written under the same trust, they will be included. So those are the benefits, but you've also got to remember we have exempt beneficiaries. So some benefits aren't counted because they're going to to a spouse or a civil partner, or they're getting paid to charity. Um, I don't want to be unromantic here, but there are some very good reasons sometimes to marry. Some very good tax reasons to marry, and it's certainly if you're talking about inheritance tax, it seems to be the area that's left that is really still doesn't work in favour of people who are living together and partners, compared to people who are married. So it's well worth thinking about that. I don't want to say it's an action point to try and organise weddings for your clients, but it's probably something to bear in mind. Okay, so what else is included? Right, I think I'm just going to put this slide up because this is something that we are getting a lot of experience of at AJ Bell. And it's just really to say if you are thinking about nominations in the next 9 months, or even where you've had someone has died and you're working through the death distribution with the provider, then it's worth bearing in mind that it might be an idea that if the spouse is inheriting both the estate and the pension, and the spouse is well off, doesn't need the pension, has no need for any extra income, is quite self sufficient, then if on second death you were planning on passing the pension down to the children, it might be best just to skip a generation now. If it's passed now to the children on any deaths before April 2027, then there's no inheritance tax implications, and it just makes it easier. We get cases coming across our desk. I'm one of the people who signs off on death benefit cases, and we do get cases where an 88-year-old widow, who may even have a power of attorney or something, is getting both the estate and the pension. And it doesn't seem to make a lot of sense to me if you can pass the pension on now with no inheritance tax. Think about nominations though after April 2027, and you might want to go back to just passing it all to the exempt spouse. Nil rate bands, this is worth mentioning. There are two different types of nil rate band. We've got the main nil rate band, which is 325,000 and has been for, I think, almost 20 years now. If it had been rated by inflation, then it would now be worth round about £570,000. But it's certainly one of the areas that just hasn't been touched in recent years. We've got the residential nil rate band as well. Now that's 175,000 as long as the residence is left to direct descendants. You will know that it's tapered if you're over £2 million. It's going to be interesting, I think, for some people because it's with the addition of pensions being brought into inheritance tax, it's going to have implications. It's going to push some people into paying inheritance tax for the first time, if you see what I mean. It's going to tip them over that edge. It's also going to maybe increase the amount of tax paid by a lot of people. But certainly it could mean for some people that they start to see their residence nil rate band begins to be tapered. And that's certainly where you get that. Do you remember that 90% effective tax rate, which was doing the rounds about a year ago? And that was why, because the people lost their residential nil rate band because of the pension being added into calculations. The nil rate band will be proportioned across the estate and each pension scheme. So you've got to count each different pension scheme and the estate, and then you work out what the proportion of the nil rate band is going to be. We think at AJ Bell that when we say nil rate band, we're talking about both of them, both the nil rate band and the residential nil rate band. And that's because of the way that the residential nil rate band is described within the IHT manual, and also because we've seen examples from HMRC where they've included it as part of the nil rate bands that have been proportioned between estate and pension scheme. Other people have different views, and I think this is just one of these areas that we need some clarification from revenue, and we need to see some examples in their guidance about exactly how they think is going to work in practice. But we think it's the nil rate band plus the residential nil rate band, and that's what's proportioned. Okay, I'm going to go very briefly through this slide because I imagine that you know all of this. This is just a reminder about how tax works on pensions. And the key age is the age 75. Now that remains going forward after April 27. That still applies. Whether someone whether the beneficiaries are subject to income tax or not really depends upon the age the member dies, age 75 or above. If you're talking about beneficiaries drawdown and the beneficiary having inherited the funds, then it's the date the age the beneficiary dies, not the age the original member died. So it's the age the beneficiary dies. As you know, before 75, then very generally there is no income tax paid. It could be income tax if there's, when we think about the lump sum and death benefit allowance, or the 2-year rule, but generally no income tax. If the member dies over the age of 75, then income tax is, or the pension payments are subject to income tax. Inheritance tax. If there is any inheritance tax, then that is deducted first from the pension scheme. Anything remaining is then subject to income tax. So inheritance tax, then income tax. Now, I personally think this is really unfair. I think the revenue is, what the revenue is doing is looking at a pension benefit, and then it is taxing it as capital. Any capital remaining on death and is subject to inheritance tax, so it's taxing it as capital. It's then taxing it as income. So it's a double whammy of taxation. I think this is unfair. I think a pension benefit should either be counted at that moment in time as a capital amount or as an income amount. I don't see the logic, and I just can't get it quite square in my head, why it should be both at the same time. In this example I've got, it's for just to illustrate the effective tax rates, and so I've assumed no nil rate band applies. But as you can see, once you add the both tax rates together, you get a really high effective tax rate, 64% if we're talking about a higher rate taxpayer, and so many more people are higher rate taxpayers. So it's worth, again, looking at this and bearing this one in mind. Now, as you will know, under inheritance tax, there are certain reliefs that apply. Now, unfortunately, these reliefs haven't been crossed over, or many of these reliefs haven't been transitioned over to pensions. So if we're talking about loss on sale, so if a value decreases in value since death, then that relief isn't counted within pensions. Neither is agricultural property relief nor business property relief. And also, if you have a commercial property within your pension, you are not going to be given the option to pay in installments on that for your inheritance tax. Whereas if it sat within the estate, then paying in installments would be allowed. So quick succession relief, where the asset is subject to, or inheritance tax is due on the asset within 5 years, twice, so it's taxed twice within 5 years. That is applicable, but that's the only real one. Now, when you look at the technical note, the reason the HMRC gives for this is it says, well, it's because it's not the member's property. It's because it's held under trust, and therefore these reliefs don't apply to it because it's not the member's property. And again, I may be approaching this with a little bit of a simplistic point of view, but if it's not the member's property, then surely it doesn't go in the member's estate for inheritance tax. So again, I dislike this this approach and this way forward, and this is certainly something that we are raising with the revenue, and we have raised with the revenue. I think this is really just intrinsically unfair. It's either in the estate or it's not in the estate. This halfway house doesn't sit very well with me. I'm just going to finish this section by looking at gifts to charity. Um, you know that if you pay net 10% charity, then you can reduce the rate of inheritance tax. People will have written their wills on this basis with these calculations. Once you add the pension into the mix, then all the numbers change. So this is just one to be aware of and one to raise with your clients and with your solicitors as professional connections. If they have written the will on this basis, then you may want to go and re-look at it because the pensions is going to put everything, all the numbers askew. So go back and look at the maths. Okay, so that was the essential information. I'm just going to go through the process of how this is going to work in practice. There are 5 main steps to it. So we're going to request the valuation, then you've got to request the beneficiary's details, going to go through what a withholding notice is, what the options are for paying inheritance tax, and then the final mop-up, which is an important part of the process. But before I start, I wanted just to cover what we're looking at here. We are looking at 2 different processes. We have 2 different things going on at the same time. As a pension scheme, once we hear about somebody's death, and if it's written under discretionary rules, as most of them are, then the trustees have to figure out who the best person is to inherit the money. It's not driven by the will, but it's driven by discretion, and discretion we take into account expression of wishes, but the member cannot direct the payment. It's up to the trustees to decide how the payment works and who the money goes to. So the pension scheme will be doing that particular process. At the same time, the personal representatives have to work out what inheritance tax is due on the estate and on each of the pension schemes. So they will be working that out, collecting all the information, submitting it all to HMRC, working out all the figures, and then coming back to try and get the IHT paid. These 2 processes are going on side by side, but they're going down different tracks. They're not part of the same process, but there is a lot of exchange between the 2 processes. So both are dependent on each other to some extent, but it's best to remember that they're 2 different things. Okay, so the first thing is the personal representative has to request a valuation from each scheme. A couple of things to point out. You as an advisor could write to AJ Bell and say, okay, Dave Smith, I'm afraid he has died. Can you note that? And can you take the process forward? And we can, of course, and we would start doing the death benefit process and the distribution process. We cannot kick off the inheritance tax process, though. The personal representative has to do that. So even though you as an advisor might tell us about Mr. Smith's death, we would need to hear it from the personal representative, and we need information about who the personal representatives are, and we need just proof of who they are. We can give out, the other person who can ask for this information is a prospective personal representative. Now, you might have cases where the will is under dispute, or somebody doesn't want to act as a personal representative, or someone dies intestate with no will whatsoever, or they can't find the will, 100 reasons. So in those situations, we can supply information if we get a request from a prospective personal representative. But I think that's quite difficult, and it puts pension schemes in quite a difficult position, I think. For example, if someone dies and the partner writes to us and says, I want information about how much their pension scheme is going to be worth, and I'm doing this as a prospective personal representative, then we would probably look at that and go, actually, I don't think you are, because under the laws of intestate, you are not going to inherit. So actually, I don't think we can give you that information. So you might find there's areas where pension schemes rub up against this prospective personal representative. Again, hopefully this is going to be where guidance is going to be invaluable and to help us all figure this out. So the personal representative asks us for information. We have 28 days to provide it. We provide estimates or we can provide the actual information. We're going to know in lots of cases what the valuation is. That's not going to be issue. It's not going to take us 28 days to do that. It is going to be more problematic when we're talking about illiquid assets or assets that aren't valued on a regular basis. If we're talking property, things like that, then it could be that we just provide a recent estimate. We've also got to give the personal representatives a split between exempt and non-exempt beneficiaries. Immediately following death, it's unlikely that we're going to know that because we need to do our investigations to figure out who these people are. So we've got to give it within 28 days of the request or 14 days after we determine it. So as I said, these two different processes, we probably won't know that bit of initially, and that's just something we have to give to the personal representatives once we got that. Once the PR or the prospective PR is aware that IHT count is needed, then they can ask for details from the pension scheme for the beneficiary, and we would have to give them details. And again, we have to give that within 28 days or 14 days of knowing. There could be some issues around this. We get all sorts of difficult family problems where one party doesn't talk to another. And there could be situations where we don't feel comfortable giving out beneficiary details to, say, the PR, if the PR is a child of the person who's died and feels resentment because the beneficiary is a partner or something like that. There's all sorts of things that can go on there. So we will see exactly how that works in practice again. One of the original issues that we had with this is that if you're doing these two different processes and we conclude our process ahead of the game, so we've worked out who the money is going to and we feel comfortable with giving it to the right person and the pension scheme pays out the money. Now, if inheritance tax is due on that particular amount of money, we would maybe just, we were relying upon the but that we didn't actually know what that inheritance tax was, and you couldn't actually say make a payment from it. So if you knew that inheritance tax was probably going to be worth but wasn't sure exactly of the amount, the full amount could have been paid out to the beneficiary, and the beneficiary could have walked off into the sunset, and the personal representative could have spent a lot of time and money trying to get that money back off them to be able to recoup the inheritance tax that they had paid. If the beneficiary had subsequently gone abroad, then there would have been no chance doing it. So the HMRC has decided that what it's going to do is allow personal representatives to put a withholding notice on pension schemes to say you can pay out 50% of the benefit once you've figured out who the money is going to, but you've got to keep on top of the other 50%. You've got to keep that back, and that will cover any inheritance tax plus any late interest payments as well, but late payment interest rather, that it will cover that. So you can keep 50% of that back. I think this is probably quite a sensible move forward. It's not going to apply to excluded benefits, obviously, or exempt beneficiaries. So if it's all just going to the spouse, then whether we get a withholding notice or not, we would just pay out. It wouldn't apply to if it was just all being paid out to the wife. If we don't get any notice, we will just pay out the amount when we figure it all out. And we also have to tell the beneficiary what we have done. My only concern with this is I think a lot of the time some solicitors and some estates may just take the action that, do you know what, I'm not too sure if inheritance tax applies or not, but I'll just slap a withholding notice on it anyway. And the problem with that is if inheritance tax isn't due, it could just mean that the beneficiary gets 50% of their money now and then 50% of their money later. Only the personal representative can actually lift the withholding notice or if the relevant IHT is paid. So it's worth bearing that in mind. It could be quite difficult to lift this to get those payments back out to the beneficiaries. The absolute stopgap is 15 months after the date the person died. If you're talking about paying inheritance tax, there are three different options and three different ways you can pay it. The personal representatives can pay the inheritance tax from the free estate. So they sell another asset or bank account or whatever it is, settle the whole IHT bill in one go, and let the pension scheme pay out in full. Alternatively, the personal representative or the beneficiary can ask the pension scheme to pay the inheritance tax bill for them. And in that case, the pension scheme pays the inheritance tax bill and then it pays out the money to the beneficiary, and that money may be subject to income tax. Or the beneficiary can choose to pay the inheritance tax from their own pocket, either before or after they receive the pension benefits. If you are paying it from the pension scheme, then income tax is only applied to the amount remaining once inheritance tax has been paid. So once you've deducted the inheritance tax, you only pay income tax on the remaining amount. So if you pay out the full amount from the pension under option one, then you're going to have paid too much tax, too much income tax, because you're going to be paying income tax on the amount which is going to be paid for inheritance tax. So in those situations, there's got to be a tax refund, and that goes back to the beneficiary. So if the scheme pays the inheritance tax, the beneficiary or the PR can ask the pension scheme to pay it. We have 35 days to pay it. We got given a certain amount. It's got to be over £1,000. It can include late payment interest as well. 35 days sets us a problem because it may be difficult to pay illiquid assets that quickly, and certainly property it could be difficult to realise to pay. So it could be that we just are unable to pay the inheritance tax within the 35-day window. I think there's all sorts of issues if we're talking about illiquid assets. Final stage, mop up. Inheritance tax is rarely concluded cleanly. People find different assets after the end of the process. They might find an additional pension scheme, you never know. So all of that is going to be difficult to work out, and therefore adjustments are probably going to be made. The more assets you have, then that changes the nil rate band, and then once the nil rate band changes, that changes the inheritance tax due on the pension. So there are going to be adjustments, both for and against. So it's an important fifth stage. Go back to my original slide, two processes. Remember, these processes apply to each pension scheme which the member has. If you are leaving your spouse or your children with 6 different pension schemes and an estate to wind up, that's a big deal for them, and it's a difficult thing for them to tackle. So maybe consolidation is in order. Most people die when they get older. Sorry to sound so blunt, but most people die when they get older. They've probably consolidated their pensions beforehand, but it is certainly worth thinking about. The personal representative, as I said right at the very beginning, has to write out to every single pension scheme they know about. The trick is actually knowing about all those different pension schemes. And for the first phase of the pension dashboard, the personal representative is not going to be able to go on and use the pension dashboard to find all those lost pensions. So the member doing some preparation on this, making sure all the details are written down, is going to be incredibly beneficial. Let's have a look at a very quick case study. This is Janet. She is a widow. She has 2 beneficiaries, Jack and Julie, and the money is going to them 50-50. She has a house, a SIP, she has other assets. It all adds up to 1.625. I've taken the nil rate band and the residential nil rate band. Janet's husband, when he died, he didn't use any of his allowances. He passed it all over to Janet. So therefore, she has £1 million nil rate band. And that is proportioned between the SIP and the estate. So the SIP gets £200,000 worth of nil rate band. So the IHT due on the estate on the SIP is therefore £50,000. Okay, so the beneficiary can pay that money, and that £50,000 can be paid directly by the beneficiary from their money. Alternatively, the estate can pay it as well. But let's look at first at this first option of the beneficiary paying the money. Jack pays it. He pays the HMRC £50,000. Say he just uses a bank account, but that means £25,000 less is going out to both him and Julie. It doesn't mean any inheritance tax is deducted from the pension, so the full amount of 162,500 is paid from the pension. 25,000 of that is really the IHT. So both Jack and Julie are due a refund from the HMRC when they take the taxable income. If you're talking about lump sums, that's fairly easy to work out. You just do it as part of the self-assessment in that particular tax year. If you're talking about drawdown, then I think it's a little bit more complicated, but it should be just when they're doing drawdown. And it may be that you just have to make you have to do it over 2-3 years to try and get the tax refund paid back. But hopefully guidance will give us a lot more information on that. Okay, so if you're looking and comparing these two different options, then we have SIP distribution between 162,000 on the first one. Pay income tax on that. That means Jack gets 97,500. He's due a tax refund. That tax refund is 10,000. You add that on, so he gets 107,500. But remember, he's lost out on that 25,000 from the estate. So when you take that into consideration, you get 82,500. That's exactly the same answer you get if you pay it through the pension. The pension pays the IHT, the rest is subject to income tax, and the remainder is paid out. Okay, let's finish off by looking at some of the planning aspects. Okay, so you have pensions and PCLS and taxable income. So if you have excess savings within your pension, and many people set up their pensions to have a legacy to pass on to their children and their grandchildren. The way that tax benefits work at the moment on pensions on death is extremely generous, and we have all been taking advantage of this and adapting planning around this. Spend pensions last is the mantra, isn't it? So going forward, people may say, I've got too much money now in my pension. I've got excess savings I don't need. How can I take it out? Take it out PCLSS or taxable income. And then you've got the options. You can spend it, or you can gift it either directly, or you can gift it by putting it under trust and protecting it from IHT. You could spend it and spend the money and spend it on cars or family holidays, or you might think that you need the money later on for care, and that's another situation. I never think spending it is a problem. I'm sure I can come up with loads of ideas about how to spend the money. One word of warning on this, FCA will be looking at this particular angle, I think. We're making a judgment about how much money that you can take out, how much is excess savings. And now that can get complicated. DWP is very fond at the moment of saying a pension is there to provide an income in retirement. And FCA also repeats this phrase as well. Pensions are there to provide an income in retirement. So don't spend too much, because you don't want to leave the person in the position where they run out of money. So it's always been worth thinking that when you're trying to work out excess savings. But the FCA may look at this particular area just generally on what you are advising at this moment in time. And remember, they're going to be looking at it with the benefit of hindsight. So when you're going through your planning activities at the moment, keep all of this at the back of your mind. Make sure it's really good records, really good reasons written down why you're advising somebody to take their money out of their pension, pay tax as a higher rate taxpayer, and then buy a fast car or whatever it happens to be. FCA will just want details on exactly how people are approaching this. How do you get, could you do with that money? How can you pass it on if you decide you want to gift it? Well, we have our usual lifetime gift allowances, which you know about. These have not been updated since 1984. Now, a wedding might have cost £5,000 back in 1984. Now, I think it would be hard pushed to cover the bar bill. So these have never been updated, and I think now that they are really showing their age. You can pass on more money outside those allowances, and you can do it by making it a potentially exempt transfer. And you can make gifts of any size, and as you're looking for that 7-year window, as you know, for whether it's going to be any inheritance tax is going to be paid. But certainly doing planning ahead of death and moving money out ahead of death is going to be very useful, and it's looking for that 7-year window. If you want to give a gift to the family, there are two ways you could possibly do it. You could do it either under a trust, or you can do it direct. If you do it direct, then it's a potentially exempt transfer. It's a pet. It's simple. It's easy. You don't control the money. You've got no way of getting hold of the money again. You've got to trust them to do what you think, what they're going to do with it, and the right thing to do with it as far as you're concerned. They have the freedom to spend it however they think they want to spend it. Hopefully they could spend it in ISAs or in pensions, and they could pass the money on that particular way, and that would be beneficial for them. If you don't have that much trust in your families, or you want a little bit more control, you don't quite feel that giving the money direct to the 18-year-old is the best way forward, then obviously setting up a trust. And there are different types of trust and various different types of trust, which I'm sure you're completely well aware of, which can give you varying levels of access, control, and varying levels of access as well. And you can retain some access where it's not necessarily completely out of the estate. And I think all of those is very beneficial. They are complicated, and they are tax situation is complicated, and it's something that you're just going to need to know to be able to make a comparison. Certainly giving the money direct is simpler, but there could be very good reasons to set up trusts and also think about the investments that are held under trusts and onshore and offshore bonds. And as we know from this last year, the sales of onshore bonds have absolutely rocketed. I think they've doubled over the last year, or the last 18 months since we've had the IHT announcement, which shows that many advisors are taking that particular route when they're talking and planning with their clients. You can make gifts out of income as well, and gifts out of normal expenditure. Now, there's no limit on how much you can give away in this situation, but you've got to obey those 3 rules. Payments have got to be from clients' regular income, they cannot affect their usual standard of living, and it's got to be part of a regular expenditure. There has to be a regular established pattern. What is a regular established pattern? Well, unfortunately, IHT manual is very short on absolute concrete details when it comes to this particular, and to a lot of things, but this particular element. You could argue that 2 or 3 years is a regular established pattern. Certainly 30 years is a regular established pattern. But you need to try and find that, and to make sure that is documented. What counts as income? The usual things count as income: salary, rent, interest, dividends. Pension income counts as income. So you could receive income from the pension, pay tax on it, and then gift it out of normal expenditure. What doesn't count? Bonds won't count. It's a return of capital. Purchase life annuities are partly capital, maybe a little bit of income within that. Tax-free cash is the one we always get asked about. If you were to take if you had £1 million in your pension and you took £250,000 of it as tax-free cash, and you gifted all of that as in one go, you'd be hard pushed to say that was income. If you phased it out of your pension and passed it over a 20-year period, then that can be argued as being income. The reality is that most situations sit in between those 2 parameters, and therefore it's going to be a judgment call for HMRC looking backwards saying, was that actually out of normal expenditure or not? If you are dealing with the family and try on the day on the death and looking at all of this, then the PRs need to keep good records, need to be able to demonstrate what somebody's income and expenditure was from say 7 years ago. I'd be hard pushed to know what my income and expenditure was 7 years ago, so trying to prove it for somebody else is going to be impossible. I would really recommend having a look at this form because it allows you to detail and to note and to record the right information that you're needed for the IHT form and would work. Okay, as I said before, you could give the money direct to the client and therefore direct to the family. They could pay it into ISAs, they could pay off debt, they could renovate the house, they could pay into their pension. So I'm just going to finish this section by showing you an idea of how this pension, how you could pay into a pension and keep it tax neutral for the family. We've got Jeff. Jeff's got a pension and he takes £20,000 from it. He's a higher rate taxpayer, so he pays HMRC £8,000 on that pension. That leaves him 12,000. He passes that to his children. His children are both higher rate taxpayers and he's both in their 30s or 40s and he passes it directly to them. And they put it into their pension. So they each put £6,000 into their pension. His children then top up their pension with an additional 2,000. So I'll come back to why in a minute. They pay in another 2,000. That makes it £8,000. You then get automatic tax relief from HMRC because it's gone into a relief at source pension, a SIP, and therefore that tops it up to £10,000 each. And the HMRC tax bill has effectively, the effective HMRC tax bill has gone down from 8,000 to 4,000. Because Gemma and Simon are both higher rate taxpayers, they claim back the additional tax relief through their self-assessment and HMRC pays them another £2,000 at the end of the year. So that way, excuse me, that way, Jeff has taken out £20,000 from his pension. Gemma and Simon have got £10,000 within their pension. And as far as the family is concerned, that is tax neutral because you've got your money, which you paid to HMRC, has been redistributed back to both Gemma and Simon and their pensions. Going to end on this slide just looking at factors. Planning is really, really difficult going forward. We had a mantra that you'd spend the pension last. That's not the situation anymore, and it's a lot more complicated. However, please do not think this means that you spend the pension first or that you ignore pension savings altogether. Pensions are still really valuable, excellent tax reliefs, tax advantages, and are certainly worth being part of a client's planning strategy. So when you are thinking about what assets to spend and in which order, there is no simple rule I can give you. I cannot say to you, spend this one, then this one, then this one. It doesn't work like that anymore. It is very much driven by personal circumstances and the individual involved and the families involved. You've got to think about life expectancy. You've got to think about how long that person is going to live for because you need to work out how long the pension has got to last for. There is no point taking money out of the pension and gifting it away if it means that you don't have money to live on when you're 93. You've got to think about healthy life expectancy as well. It's not just what people need at the moment, it's what people are going to need in the future. And unfortunately, although life expectancy is going up, healthy life expectancy is not going up, or not going up at the same rate anyway. So you need to think of all those factors as well. You could gift money and give money to benefit to families, but you need to think about when you're going to gift the money and the income tax you're paying. It's not only the income tax that you pay or the client pays when they withdraw the money, it's also the beneficiary's tax rate that's really important here. So it's thinking about the income tax paid at both taking out the pension and then what the beneficiary has to pay. But it's also thinking about it over the whole lifetime of the pension, not in just one particular year, but looking at the whole lifetime of the pension, and thinking about it in much broader terms. There are, as I said, no simple formulas. Blended families, I have a blended family and they are an absolute joy, but they can make planning very much more difficult. So it's worth thinking of that. People don't necessarily belong in this nuclear, two parents, two or three kids. And access and control is really important. And that's where trusts have an enormous role to play within your planning discussions with your client. I hope you found that interesting. It's quite a lot we've gone through this morning. As I said right at the very beginning, I think that my main message coming for you probably today is that this is complicated stuff. It can be complicated, but it is really beneficial for you to know all of the details for this, and how it works in practice, because you will be able to demonstrate your worth, certainly to all of your customers. To your clients. Freudian slip at the end.
Brilliant. Thank you so much, Rachel. I think for us, as providers, as advisors, we're all fully up to speed now that these changes are going ahead. The proactive conversations with clients are happening. I think a lot of noise in the market now is more around the how, the logistics, how the pension companies are going to cope with this, how HMRC will put this into practice. So actually a lot of the content that you cover today has really helped to answer some of them questions. And like you say, there'll be more that will unfold in the next 9 months. So we've still got about 8 minutes or so for questions. We've had a good few questions coming in. So just before we get into it, just to say there will be a survey at the end. So fill in your details. We can send over copies of the slides. The recording will also be on the Foresight website, so you can go and get the sort of transcript from there. But we'll jump into questions now. So one of the things that come up is many clients now will be aware of the pension changes and the noise around IHT. And actually for advisors, it's about differentiating the clients that need that proactive contact or those that simply need sort of reassurance. What's your sort of thoughts and views on that at the moment?
I think it's a difficult one, this, because what happens, and I know very much that the press will report this. There's a lot of stories within, say, like the Telegraph, which run with this, and they can send clients into a bit of a frenzy, into concern. It's worth looking at your client bank. You will know which of your clients may possibly be paying inheritance tax, but because of the amount of and you will know how much pensions they hold as well. So I think in a way it is a case of just sorting through your clients to figure out exactly who's going to fall into this and who's not. It's going to be some really fine lines there, but you're not going to know necessarily all the details for the estate, and that's the way that is maybe starting off those conversations. Clients are going to read about this in the Telegraph, and they are going to come back and talk to you about it. And again, this is this is what makes advisors you're absolutely worth your salt. It's because of that reassurance. You can explain this to them, you can explain how this is going to work and give them the reassurance. But certainly many advisors are already working with the clients who are affected to think about their planning at how this changes. And it may be those are the most obvious clients that you've looked at so far, but I think we'll start now going looking at different types of clients with different positions.
And then you touched on some of the areas around the tax-free cash piece through the presentation. I mean, do you think we're going to see more clients now considering taking that tax-free cash early, and the sort of considerations that need to be taken when maybe having them conversations and doing some proactive planning before April?
Certainly, if you want to, if you think you have excess savings within your pension and you want to reduce the amount held within your pension, and you think that that's the right way of going forward, then taking tax-free cash seems an obvious one to do. Don't pay any tax, just take the tax-free cash. In that sort of situation, I can see more and more people doing that. Certainly, when we're looking at the FCA statistics for tax-free cash and the amount that's been taken out over to 2024, I'm going to go back to initially, that the amount people are taking out and the age people are taking out is certainly going up. Sorry, the age is the same 55, but the amount people are taking out is going up. Now, this could be fueled by inheritance tax, but I'm afraid a lot of it is also fueled by tax rumours around budgets, which have been completely frustrating. For someone who works in policy, we have lots of conversations with the government, and we've been saying this message for the last 2 years that people need stability, and this is one of the problems: is people need stability. They need to know that they're saving for a long time, and therefore they need the guarantee that the goalposts won't be moving. So the combination of both those budget rumours and the inheritance tax fears, I think, has just shown through very clearly within the figures about the amount of money that's being withdrawn. So, but again, it comes back to that main point, Lauren, is working out exactly what is excess savings and what isn't excess savings.
And then I know there's a lot of noise at the minute. So, for instance, I worked at a large pension provider for a good 10 years before joining Foresight. And I know at times, even without all of these changes, there was sometimes a sort of a struggle or a battle with some of the sort of servicing and admin that goes around just the normal general day-to-day admin that comes with pensions. With all of these changes coming into place, with April fast approaching, how do you think these pension providers are really set up now to potentially deal with these increase? We know that there's going to be money moved, there's going to be restructures taking place. Do you think that admin process is potentially going to become a bottleneck? And how do you think the big providers in the market are sort of getting themselves ready for this?
I think when you're talking about withdrawing money and you're talking about withdrawing tax-free cash or increasing the amount of money you're taking through income, with all of that, I don't think that's a problem. I think that is just bread and butter, if you see what I mean. It's just the daily processes. Most pension providers have got that quite slick. It is just doing those sort of processes. And I think all of that should just work exactly how it has worked, even if we are seeing increases in it. We saw over the budget period that it's still more or less just all happened how it should happen. The issues where we may come across some administration problems is probably going to be around the new rules with inheritance tax and paying the inheritance tax or working out valuations or all those sort of issues that I went through at the beginning of the presentation. And those are probably more likely the areas where we're going to have a couple of stumbles. And that's just while we get used to exactly what's happening. We understand the complete rules of what's happening and we build the processes, because this is really big changes and we haven't got a lot of time to put them in place as pension providers.
And then one final question before we wrap up. So we've had a number of questions come in. For anyone that's questions hasn't been answered, we'll get you the answers in the follow-up. There was a question just around, you talked about that mop-up process. Are deeds of variation considered when the mop-up process takes place?
Deeds of variation as in for the will. I think it's all to do with the timing with this. I think it's to do with a personal representative has to go through this whole that's the wrong word, palaver. This whole palaver of working out when inheritance tax is due, when it's got to be paid, how it's going to work. And I think sometimes you can get to the end of that process and then think that's it, the job's done, that's absolutely finished. And then you get the stray record or the stray email from, I don't know, a building society or a pension scheme or something like that. And you think, well, actually, I've forgotten that particular asset. So it's to do with those sort of particular elements. And I think, as I said before, it just sets it all obscure, and it's understanding what that process is going to be. We're still working with the revenue on that. We're hoping that we can make it as easy as possible. If another asset is found within the estate, then it seems just readjusting everyone's nil rate band and therefore readjusting the tax due on each particular pension scheme feels a little bit over the top to me. And hopefully we can work with the revenue to find much simpler ways to do this. But certainly this mop-up exercise, it's just, don't forget about it. It is part of the process.
Brilliant. So we're bang on time there, Rachel. Thank you so much. Like I said, you've probably answered a lot of questions that have been on advisors' minds. I know that you've answered a lot of the questions that I've recently seen in the client and advisor meetings. So that's been great. As mentioned, you will get a survey come through. If you would like that follow up on the slides, please complete the details, and any questions that we didn't get to answer today, we will come back to you. Just finally, from us at Foresight, Rachel, a massive thank you. That's been brilliant. And this recording will be on the website for anyone that wants to go back to it.
Okay, thank you very
Thank
much,
you
Lauren.
all. Thank you.
Okay, bye.